When a conventional business needs to buy equipment or inventory, it draws from an interest-bearing line of credit. The bank lends the cash, charges interest on the timeline, and takes no responsibility for the item itself. Today, we break down Murabaha, the asset-backed alternative that entirely replaces predatory credit with transparent cost-plus commodity trading. The core operational secret of Murabaha is simple. The financial institution completely drops the persona of a money lender and steps into the market as a physical merchant. Instead of handing you cash to buy an asset, the bank purchases the asset itself from the supplier, takes legal ownership of it, and then sells it directly to you at a transparent premium. Under the strict rules of a Murabaha agreement, total transparency is legally mandated. The bank cannot simply quote you a single consolidated payment number. It must explicitly state the exact original cost price it paid to the supplier and separate it from the precise fixed profit markup it is charging for the transaction. To understand why this is a legitimate trade and not hidden riba, we must track the sequence. First, the buyer identifies the asset and promises the bank they will purchase it. Second, the bank executes the buy order, takes the physical asset onto its own balance sheet, and accepts all ownership risks. Only after taking possession does the bank resell it to the client on a deferred payment schedule. This temporary ownership window is what separates trade from exploitation. If the asset is destroyed, lost, or damaged while in the bank's possession before being resold to the client, the bank suffers 100% of the financial loss. Because the bank accepts real asset risk, its right to realize a profit margin is fully validated. For corporate operations and scaling technology platforms, Murabaha is the go-to engine for heavy asset procurement. Whether you are scaling out physical data centers, purchasing logistics fleets, or acquiring heavy manufacturing equipment, Murabaha allows you to spread out your payment timeline while remaining completely asset-backed. But how does a Murabaha contract handle default without turning back into riba? In conventional loans, if you pay late, the interest compounds, multiplying the debt. In a Murabaha transaction, the cost-plus price is fixed from day one and can never increase. The bank can charge a penalty fee to discourage late payments, but it cannot pocket that money. It must legally purge 100% of that penalty directly into a verified charity. When contrasted side by side, the structural divergence becomes completely apparent. A conventional line of credit is a financial loop built on floating interest and compounding penalties. Murabaha is a highly transparent, fixed-price commercial sale that anchors finance directly to real-world industrial supply chains. The Murabaha framework provides a powerful masterclass in real-world asset trading. It demonstrates that global commerce can thrive efficiently without resorting to hidden credit loops, bringing total transparency back to institutional trade finance. Now that we have fully mastered how to acquire ownership of assets through equity partnerships and cost-plus trading structures, we need to look at how the ethical sector manages asset utilization and temporary leasing. In our next lesson, we break down IDRA, the definitive alternative to conventional equipment leasing and rental contracts. Hit subscribe, and let's keep building wealth with a conscience.